What's up, guys? We are back again. Real Estate Keys, another episode, another week. John Johnson, yours truly, Johnson Signature Group. I'm here with my man, Joseph Falla. Joe does mortgages. And today, we are going to talk about hard money lending. And I'm sure we've heard that term thrown around when it comes to buying real estate, specifically when it comes to buying and flipping real estate. But Joe's going to spend some time to walk us through what that hard money lending stuff really means. So, Joe, reintroduce yourself, man, and what's up with these rates?
The rates. Hello, everybody. Welcome back. Welcome back. So the rates. Let's see what we have here today. They've been pretty much steady from what we saw from the last couple of weeks. You can see here in regards to the mortgage market, it was a green day. That's what you see all the green numbers there. So your fixed, your jumbo loans, your VA loans, they're pretty much in pace of what they have been in the last couple of weeks. So anything in the green is a good day. So you can see these are not my rates or anyone. I'm not quoting anyone's rates. This is just an average of someone with a 740 credit score putting 20% down. And this will give you an approximate of what your interest rate would be. So, they are what they are, John, as usual.
Yeah, and if you really think about it, these are like your pre-COVID rates. We were spoiled during COVID with those 50-year low interest rates, in the twos. And now this is kind of normal. I mean, this is kind
It
of
really
what,
has become, yeah. It really
yeah,
has been. Absolutely. But this gives you a good gauge, guys, of what we're looking at right now. As always, if you want a more accurate number, feel free to DM me, call me, and I'll be more than happy to assist. So, John, you mentioned hard money lending. I guarantee you go on YouTube, and it's got to be one of the probably like the 20 most recent searches on YouTube or on the internet at any time of the day. It's become a real niche word to throw around. Hard money lending, and it has a negative connotation to it as well. Just the word itself sounds like someone's going to beat you over
mm-hmm.
beat you over the head with a bat if you don't pay if you don't pay them back on time, right?
Uh-huh. Uh-huh.
So I'm just going to go over some stuff here today, and then we're going to go over some questions and answers with John here as usual. So hard money lending. So hard money lending is essentially, the money can come from different places. It can come from investors on Wall Street. It can come from doctors, lawyers, banks, private money, people basically on the street, right? That's looking to get into to spread their money around. The stock market isn't always in the green. So this is an alternative for people looking to make some good money back on their some good returns, right, on an investment. So hard money. These are some of the terms we're going to use today, right? You're going to use the BRRRR, right? Some of you guys may have seen that on the on YouTube as well. We're going to use interest only. We're going to talk about points, loan to value, ARV, bridge loans, asset-based loans. We're going to use terms like rent rolls, things of that nature, right? So I want to give one of my favorite strategies out there that you can actually implement with hard money is the BRRRR strategy. Have you heard of the BRRRR strategy before, John?
I have heard.
Okay. What do you know about it?
What do I know about the BRRRR strategy other than
Yeah.
what you have up on the screen?
Hold on, I'm cheating. Go.
No, I mean, at the end of the day, I mean,
Only kidding.
it's the blueprint to basically buying and flipping, and building wealth when it comes to real estate. It's buying a distressed property, it's renovating it up to spec where you can either sell it or hold on to it to rent to some tenants, which will build, some residual income. And then as things start to appreciate with that property that you have renovated, you refi, pull money out, and you use that money to leverage to buy yourself another investment property, and you do that over and over and over again. I mean, it's one of the oldest blueprints that has been around when it comes to.
It's one of the easiest ways.
Yep.
It's one of the easiest ways to get into real estate. Now, I say easy, right? That doesn't mean that it comes with a pile of cash at the end of that, right? You do have to put some equity to get into one of these types of strategies, right? So you hit the nail right on the head, John. So it is one of the oldest methods. It's one of the easiest methods. So essentially, like John said, the BRRRR method is where you buy a property, you rehab it. Once you're finished rehabbing, you're going to go out and rent it. Once it's rented, you're going to then go out and refinance up to a certain LTV, loan to value, or after repair value, right? That you can where you can actually pull equity out of the house. So you give $1 and you get back $3, essentially, right? That's basically how the strategy works. And what you do at the end is you repeat it, rinse and repeat, that easy. Mm-hmm. So again, many of you guys may have seen this strategy on YouTube, Bigger Pockets, websites like that. So, right. So here's an example of how this works. Now, these numbers are for illustration purposes only. They're not right on the nose. It's more just to give you an idea of how a strategy like the BRRRR strategy would work, right? So you buy a property for, let's say, $100,000. It costs you $50,000 to repair it. There's taxes that you have to pay. There's lender fees that you have to pay to the hard money lender. All this stuff equals out, let's say, $200,000. That's what you're all in, right? Then you finish the project, you pay back the hard money lender, and then you go and rent out the property, right? So the rent is going to be $2,200, and let's say this is for 2 units. I'm sorry. Let's say the mortgage is $2,200, and it's a 2-unit, and you're able to rent each floor out for $1,500, right? So now you've got the rent. Check. Done. Now we got to go to the second to last R. That's where I come in. The refinance part. So most banks, right, they're going to say, okay, so you've gone up, you fix up this property. It looks completely different than what it did when you sent us the pictures originally, right? Brand new roof, you added a bathroom, you redid the floors, you got that new wood floor that everyone's doing, you got the beautiful gray paint and all that good stuff, right? So now you go out, you check the comps. Now you know, well, Mr. Joseph Falla, according to my estimates, this house is now valued at $350,000. What can you do for me? We run the numbers. We have credit checks and all that other good stuff that we still have to do our due diligence on. And will most likely, again, this is just for illustration purposes, go up to 75% of the after repair value, which means you've put in $200,000. You're looking to pull out $262,000 out of this property that you've fixed up and beautified this neighborhood. Now you take that money and you actually repeat and you go out and find a new property. Again, these are just illustration numbers just to give you an idea of how this works. That's pretty much it, John. That's the process with the BRRRR strategy, how to actually pull equity out once you've actually fixed up a property. Now take that money that you've come into and again, this is with a new mortgage, right? So you're applying for a new mortgage at this point. So that's where the $350,000 is coming from. Will allow you to get up to 75%.
Okay. So, Joe, let me pick apart this example here.
Go ahead.
I use a hard money lender. I purchased this home for $200,000.
All in, you're at $2,000. Purchase, construction, closing costs, everything, all that good stuff. All that stuff we've talked about in the past, right?
Okay. Contractor goes in, hooks it up, and then I rent this property out for what you just mentioned, $3,000
a
month. I realize, hey, the home has appreciated in value. Now I want to go and get a refi. The appraiser comes out. They say, hey, it's worth $350,000. Going through a lender such as yourself to do the refi, you say, okay, you know what? We can refinance this for $350,000, but you're going to have to basically allow us to basically give you 75% of that $350,000, which is $262,000. So
again, plus closing costs, right?
Right. Plus the closing costs.
We don't want any bad messages there in the comments.
Right. Well, there's a price to pay.
There's price to pay, right? You have to have skin in the game.
Right. So 75% at 350 is 262. So all in, the purchase of property was 200. After you refi the property, you basically have a net of, let's say, roughly $60,000. If I'm doing the math right, 262 minus 200, you got anywhere between, let's say, $50,000 to $60,000, because, like you said, there are costs associated with doing a refi.
Exactly.
And you can leverage that profit to purchase something else. Am I
Exactly.
saying that correctly?
That simple.
Okay. Now,
That's simple.
Now, Joe, let's talk about the first point of entry into the scenario, which is that hard money loan. So is that hard money loan like a regular mortgage, like we've been talking about in previous episodes, or does it work a little differently?
It's sort of like a bridge loan. So many of you may have heard the term bridge loan in the past. It's basically a short-term loan to get you from point A to point B. Okay, most hard money loans are for they're up to 12 months. That's usually what the contract is, up to 12 months. So the investor inspects, well, they're going to help you. The best part about this, I'm going to get to that, but the best part about this, you're not going to get into this deal alone. And I'm going to get back to that. So they'll set it up for 12 months. They're going to see exactly what needs to be done. They're going to give their opinion on it, and you're pretty much in. But to get back to what I said just before, an investor, as a hard money lender, private money lender, or even a bank, they're not going to approve you if they don't see your vision. And when I say your vision, they're not going to say, well, every other house in this neighborhood is only selling for $200. Where did you say that the same and the identical house is worth $400? Where are you getting that additional $100,000 or $200,000, right? They're going to say, well, you gave us this list of things that need to be repaired, but you didn't mention that bathroom that, the toilet is screwed in from the ceiling. Right? What happened to that part of the job? So they're going to actually go line by line, detail by detail, to make sure you're not getting yourself in over your head. Because you know what? And I've said this a lot, no one wants your property. They're in this, their gain is your gain. So when you make money, they make money, and they want repeat clients. They want to build relationships. This is not a one and done type of deal. The more properties you go out and do a BRRRR strategy to, the more business that, and you start to build that relationship like anything else, like any other type of business.
Right. And I'll add my 2 cents as well to it also. And just to clarify a lot of what Joe just mentioned, you have these investors that they're not going to be hands-on with this project. So to Joe's point about vision, they want to see what's called a statement of work, or they want to see a proposal that your licensed contractor can put together and basically itemize every single thing that's going to be done to this property as part of the renovation. And with that hard money lender will be able to assess, that proposal and really establish that vision to really see at the end of the day, once that project is done, once you get through that proposal, is the home going to be worth a lot more than what you're purchasing it for? And to Joe's point, these hard money lenders want to see your repeat business, because at the end of the day, they want to be comfortable lending their money out to you, you fixing up these properties, they get their money back with a little bit of profit. So you win, they win as the investor investing in you into the project, and you win obviously because you're going to have an after repair value that's substantially more than what you bought the property for. And
they're not in the fixing. Yeah, they're not in the fix and flip game.
The investor, the lower the interest rate gets as well.
Exactly. Yeah. So that's actually coming up on the next slide here. So how do we get into the hard money, right, John? That's probably what everyone's asking here, right? So this is an example of what a hard money loan would look like. When you go, when you walk into an office, you bring them the property, you bring them your scope of work, right? So let's say you purchase the property for $150,000, right? What they're most likely initially, they don't know you. You just walked off the street. You may have been recommended by someone that they worked with in the past, but they don't know you well, right? So the amount of down payment varies not on the deal, but from my experience, it varies more on your experience. So this example is probably going to be the complete opposite once you're in your third to fourth deal with this one particular hard money lender, right? And the better relationship that you build with them, the more they'll be willing to work with you, right? So first, your first day out, you just came in some good, I hate to use this term, you came in some Bitcoin money, and now you're in the real estate business, right? You've cashed out. So $150,000 purchase, they're going to ask you for 25%. This is just an example, guys. That's $38,000, right? Now, as I said originally, this is a 12-month loan in most cases. Some will go over depending on the amount of work that needs to be done, depending on the city. Permits don't come overnight, unfortunately, so all this stuff has to be taken into account, right? So how do we figure the interest, right? I gave an example of 14%. This is not your average, 3.5% down mortgage loan. In most cases, your interests are going to be a little bit higher than your conventional loans, right? There's more risk to everyone in this deal, so you're going to see a higher interest rate, right? But once you're a savvy investor or professional investor, you're going to see interest rates don't really matter. It's all about the amount of money you can make at the end of the deal or your cash flow, depending on your strategy. So let's say 150,000 minus 25%, we're looking at 113,000. What they're going to do is they're going to multiply that by 14%. You divide it by 12. That's $1,318 a month. Now, that is what you're going to have to pay in regards to your interest rate, whether the deal takes 2 months, 3 months, 9 months, or 12 months. You basically add that up. Now you know exactly what you're going to be paying in interest. It's an interest-only loan. I didn't mention that. Interest-only loan. The construction, they're giving you, in most cases, most hard money lenders are going to give you 100% of the construction costs as well, right? Then you also have holding costs, taxes you're going to have to pay, incidentals that may happen, because what most hard money lenders are going to do, they have draws, right? So they're not just going to write you out a check of $100,000 and say, well, we'll see you in the 12 months, right? In most cases, depending on the way you structure your deal, they're going to offer you money for paint. They're going to offer you money to repair the siding, repair the windows, to repair the bathrooms, so on and so forth. So each time that one of those jobs needs to get done, they're going to give you what's called a draw. They're going to come out, make sure that the work that you said needed to be done first, whatever steps you decide to go in. Once that's completed, they'll come out, they'll look at it and look at the job that's been completed, then they'll cut you a check. So that's part of your incidentals. That can sometimes hold back your job by a week. You don't know how, you don't know what could happen between you calling them and them coming out, right? In most cases, they should be coming out within a day or two. So you're probably going to want to have some extra skin in the game. Maybe have an additional 30, 40,000 where you can cover the next piece of the job on your own, and then let them cut you the check and pay you back. So these are some of the incidental costs that you're going to have to probably want to have that available to make the job just flow a lot better. There's points. They're probably going to charge you a couple of points just for, it's basically like an application fee, put it that way, right? There's closing costs as well, as we mentioned before. So these is basically all of the pieces that that you need to discuss with your hard money lender.
And Joe, just to add to that regarding incidentals, more often than not, these hard money lenders want to see you put up, that first draw out of pocket. So in addition,
it's all dependent. Yeah, all depending on how you structure the deal.
Right, all depending on how you structure the deal. Some lenders want to see you come out your pocket first, then they'll reimburse you, and then you have other hard money lenders that'll say, you know what, we'll put it out. It all depends on how you structure the deal. And
it's all based on their risk. It's all based off their risk factor.
Yep.
and how well they know you. Again, it's all about the relationship. That this is a relationship building business.
Absolutely.
I think I don't know if we said this before, John. We're in northern New Jersey. It's almost impossible for you to go out and, just not do the right thing and someone not finding out. It's like the 7 degrees of the 7 degree separation of Kevin Bacon, right?
Seriously.
Someone's going to find out about this.
Seriously.
And you don't want your name out on Facebook, which I've seen quite a few times from what I've seen investors, just blatantly put people's names out on Facebook.
Yeah.
If they feel they've been done dirty or whatever the case may have been.
Dirty laundry.
Exactly. So so they definitely the more money you come up with, the better the deal's gonna flow for you, especially your first or second try. Mm-hmm. Yeah, so that's pretty much the structure of the hard money lender. Now, how do you find these deals, right? I don't know. Maybe you can team up with a real estate agent that works with investors in a particular market that they're probably in. I'll get back to him. Maybe you can go out to meetups. I know some great meetups in New Jersey. Meetups meaning there's real estate investors. It's the best. It's really the best. Real estate investors will go out. They'll rent a restaurant. They'll rent a hotel. And set up meetups for investors to come out. Well, they'll actually bring out some sort of professional flipper or someone that does the BRRRR strategy, someone that's into multifamily renting, whatever the case may be. They usually have someone that has a topic of the day, and they'll charge you $5-10 to come out and just ask questions. That's what the meetups are about, just to come out and ask questions. They're the best. If anyone wants some links to some good meetups, I have access to quite a few of them here in Jersey. Please, hit me up, DM me, call me, whatever the case may be. Facebook. You can go out and meet people on Facebook. Bigger Pockets, I mentioned them before. They're an amazing, amazing website. They have all types of information for investing in real estate. You can go to the Union County website and find auctions where people's houses, unfortunately are coming up for foreclosure. You can go out. They literally spell out the person's. They give you the name, the address. Now, again, I'm not going out advocating people, harassing people, and knocking on their doors. I don't advocate that. You might want to maybe try to find what their phone number may be, give them a call, see if there's some way that you can help them avoid a foreclosure, right? Wholesalers. You see when you're along the highway, you see this, I buy houses. That's your first stop. Write that number down. Give them a call. These are people that have access to inventory. Or you could just follow the real estate keys.
Bing!
But that's pretty much it, John. It's really that easy. I hate, like I normally say, I hate to make it sound like it is that easy, but it really is just that easy.
Yeah, and, to your point, guys, just use the internet. Just use the internet.
Or use us.
Yeah, definitely
We're a great resource.
When you're tired of us, you got the whole internet world. You got social media. You guys probably have friends in your sphere that already have access to homes that might fit, this kind of scenario where you can use hard money to access their property, fix it, flip it, hold it, however, you want to go about it. But, yeah. You
would be surprised how many, if you see, let's say, a remodel in your neighborhood, and it's usually a guy in a big F-150, some sort of flatbed, right? Not the guys in the van, right? It's usually not the guys in the van. Look for the F-150. I kid you not, guys. Look for a black F-150 in front of a construction site or a house that's being remodeled in your neighborhood, and I guarantee you found the investor, and you would be so surprised the amount of information they'd be willing to provide you.
Yeah, and just to be clear, I don't have a black F-150. Joe doesn't have a black F-150. That's just the most common pickup truck you see in front of these homes. Either the black or the gray. It's just by coincidence, but there's a lot of truth.
Those are usually the owners. Those are usually the investors. I say 90% of the time they are the investors. They're just so easy to spot. Again, not the vans per se. Those are mostly just the workers, and they mostly don't know anything. When you show up, they're gonna be like, I don't know, some guy. He comes, he pays us, we leave.
Yeah, right. And then the other thing is, look to find a hard money lender. You can go online, you can Google hard money lender in New Jersey or whatever state you're in, and interview them. Interview the lenders. Reach out to Joe. Say, Joe, do you have any connections with any hard money lenders that you've worked with to do the refinance on? Joe has plenty of them. And
John, did I forget to mention I just added that product to my repertoire?
I think you need to speak on it. You got 2 minutes to speak upon it, man.
So, I have a broker channel, essentially, right? So, I carry my vanilla loans are my, VA loans, USDA loans, not much around here, but FHA loans, conventional loans. But I also have a channel where I can go and find you deals that you may need, like DSCR loans. We're going to cover that in the future. Interest only loans or hard money loans. If you have some sort of deal and you need to structure it a certain way, I guarantee you I have someone that can actually help us. So feel free to hit me up.
We got a lot to talk about in episodes to come.
Pages on pages.
Pages on pages. Joe, once again, you hit us in the head with something else. Once again.
Appreciate it.
Some more knowledge. Knowledge is power. Joe, how they reach you, man? Let's go.
908-669-9091. I'm Joe Does Mortgages on all social media.
Yours truly, John Johnson, Johnson Signature Group, Exit Platinum Realty, 908-338-0639. And we have come to the conclusion of another great episode of Real Estate Keys. Joe, what you leaving us with?
Divorce your landlord. Date the current rate and marry the house. Stop worrying about rates. Find a mortgage payment that fits your budget and buy it. That's what I'm going to finish with.
And in our next episode, Joe's going to tell you how you can get some of that merch as well.
Yeah, it comes with the real estate playbook. Only kidding. Inside joke.
There it is. Ladies and gents,
it's a pleasure, everybody. See you on the next one.